After touching an intraday low of 73.3025 on Monday, in the past week, the rupee gradually appreciated to end the week a lot higher at 72.97. RBI affirmed their intervention to continue in the market despite being on the currency manipulator list. It now seems reasonably certain the rupee shall hold the 73.00 resistance level, and the position of dollar flows shall determine the extent of weakness in the rupee exchange rate, with support for the domestic currency coming in at 73.70 post-budget announcement. In December, exports were up 0.1% to USD 27.2 billion, and imports rose by 7.6% higher than a year ago and pegged at USD 42.6 billion. Exports and imports are in positive zone for the first time since February 2020, indicating that trade and economic activity seem to be headed towards pre-COVID levels. As RBI expressed their intention to continue with their intervention to boost the export competitiveness, we do not expect the rupee to break the strong resistance at 73 level on a sustainable basis. The budget announcement on 1st February 2021 shall guide the direction of the home currency and stock based on the comfort or otherwise expressed in the budget announcement and the market sentiment being developed thereafter. If the stock market reaction to the budget works out to be negative, we can expect the rupee to drift lower to test the 73.50 support, which level should offer a potential opportunity for the exporters to hedge their receivables up to 6-month maturities, with the added benefit of higher forward dollar premia prevailing in the 1 to 6-month maturities. In the pre-budget period, rupee is expected to trade in the 72.85 to 73.35 zone, with the rupee remaining mostly stable in the above range. The importers enjoy the comfort of leaving their forex payables unhedged, and their stance proved to be cost effective over the last 6 months time period or more. But the exporters were placed at a disadvantage position as the rupee gradually strengthened. The unhedged export receivables up to 6-month maturities are recommended to be hedged at 73.30 to 73.50 plus spot level, and the prevailing higher forward dollar premia would help them to achieve a better realization rate. The exporters who have left their receivables unhedged over a period of time could have lost the potential opportunity to enhance their export realization, as the rupee exchange rate maintained its firm bias against the dollar, with its intermittent weakness remained unsustainable. A spot target level close to 73.00 seems to be the appropriate level to hedge the import payables, at least for the next 1 month period. The rupee's broad stability against the dollar is encouraging the importers to stay on the sidelines. The oversold dollar position in the market is increasing, and at some point of time, when the rupee shows the tendency to weaken, all such unhedged payables shall hit the market, and the bunched up dollar demand shall make the domestic currency to move lower in a short span of time. Also, the importers have to remain cautious on the possibility of foreign fund outflows happening at some point of time in the future, which may exert pressure on the rupee to depreciate much faster than one can expect. This risk has to be recognized and risk mitigation measures are required to be put in place to prevent any large currency losses which may materialize at some point of time in the future due to change in the market sentiment against the domestic currency. If the central bank allows the rupee to gradually appreciate beyond the 73.00 strong resistance, quite unlikely, the domestic currency may strengthen to 72.50 before the end of March 2021, setting a range between 72.50 to 74.00 in the set period. Though the rupee is under pressure to rise on heavy foreign fund inflows, the bullish expectations on the domestic currency shall only remain as a short-term factor. Over the medium term, the currency trend may reverse if the foreign fund flows turned negative, which is quite possible. The bullish expectations on the rupee over the medium term to long term may prove to be an incorrect and wrong judgment if the forecast is purely based on the current trends and developments. In reaction to the reverse repo auction conducted by RBI, the forward market reacted strongly and the forward dollar premium has risen significantly across the maturities. Specifically, the 3-month forward dollar premium rapidly rose to end the week a lot higher at 5.40% per annum against the level of 3.60% per annum which had prevailed a month ago.